An exchange-traded product, or ETP, is a financial instrument traded on a regulated stock exchange. And it's designed to replicate the return of an underlying benchmark or asset before fees, with the easy access and tradability of a share. Exchange-traded products offer investors access to a whole universe of exposures, from traditional asset classes like equities and bonds to alternatives like commodities and currencies, once only accessible for institutional investors. Unlike traditional index funds, ETPs trade intraday, therefore investors can buy and sell at any point during market hours and monitor prices on exchange. Also, ETPs don't impose minimum investment capital limits or early redemption charges. ETPs are typically divided into three categories: exchange-traded funds, exchange-traded commodities, and exchange-traded notes. Exchange-traded funds are structured as funds and commonly governed by the UCITS framework in the European Union, which provides a number of important safeguards for investors. Exchange-traded commodities are issued as debt securities. Unlike ETFs, they are not restricted by UCITS diversification requirements and can therefore provide exposure to individual commodities and currency pairs as well as diversified baskets. Exchange-traded notes are generally issued by banks and are usually entirely reliant on the creditworthiness of the issuing entity. Investors can also gain both short and leveraged exposure to a variety of asset classes through tactical use of short and leveraged ETPs. Unlike other short and leveraged positions, S&L ETPs do not involve borrowing, and losses cannot exceed the initial amount invested. For example, if the FTSE 100 was to increase 3% on a given day, a 2 times leveraged FTSE 100 ETP would be expected to provide a return of 6%, and a 2 times short FTSE 100 ETP would be expected to provide a return of -6%. Due to the potential for volatility of any exposure, investors should acknowledge that these are short-term instruments and that they should be actively monitored. Investors can also invest in a single currency ETP or basket of currencies. Currency ETPs aim to replicate fluctuations in the foreign exchange market. For example, if an investor believes that the US dollar was to strengthen in comparison to pound sterling, one could invest in a long dollar short pound ETP to profit from that fluctuation. There are also currency hedged ETPs, which not only provide exposure to the underlying asset, but also include a built-in currency hedge to mitigate the currency impact. For example, since commodities are priced in US dollars, a UK investor looking to enter the market can utilize a sterling currency hedged commodity ETP. ETPs come in many forms. For more information, please consult our online version of ETPedia.